Welcome to episode 8 of the Harry Sale Wealth Show. Returning to the show is my friend Jesse Merson. Welcome back.
Thanks, Harry. It's great to be back. I'm excited.
For those that don't know, Jesse is a mortgage agent at Vine Group in Toronto and is really my specialist when it comes to helping my clients with real estate questions. Today, what we're going to do is get into a few scenarios of how we've helped clients together. But Jesse, maybe just give us a quick update on the real estate market. What are you seeing these days? What are clients asking you? What's the current state of the market in Canada?
Yeah, great question. I mean, there's a lot of headlines out there, and really there's almost micro markets within the real estate market as a whole. So as far as locally here in Toronto, the condo market softened quite a bit. Obviously, there's headlines about projects being canceled. Condos are staying listed for a lot longer than they once were. Prices have come down. And then you have sort of the tranche up from that, where you have sort of the starter home, a sort of segment, which is still quite hot, although we've seen a lot of people list at a certain price and they're not getting the offers they want. And so they're taking them off the market and looking to relist in the fall. I've had a number of clients in that scenario, at least, just a number of them over the last little while where they just didn't get the price they thought. So let's relist in the fall. So we're all expecting, a fairly, an uptick, put it that way, in the fall. And then the luxury market has been doing extremely well. So, that's a market that is a little less exposed to interest rates, a little less exposed to the ebbs and flows of the market. Interest rates have been quite stable. Inflation ticked up a little bit just yesterday. And so we did see yields jump up. I haven't seen rates change yet. But, summer, July and August tends to be the quietest time of the year, just cyclically anyways, because of summer and whatnot. So I think it's going to be, pretty quiet for the next 6 weeks or so. And then in the fall, I think is when things could, hopefully sort of start to pick up again and make it more of a better market for sellers, which gives buyers more choice. And we've got hopefully some more stability, interest rate wise in terms of forward forecasting on that.
Yep. Yeah, that's what we're seeing too in terms of Bank of Canada, advising clients on how to invest, save for their house, things like that. It seems to be a lot more stable than it was around Liberation Day. So that's always nice to see. So what we can do now is really kind of get into some of the scenarios. The first one we have here is called the pre-sale strategy. The scenario is a couple is planning to sell their home within the next, call it 12 to 18 months, and they want to upgrade to a larger property. So a pretty common strategy. They currently make extra principal payments of about $500 to $800 a month, but are unsure if they should continue this or redirect their money elsewhere. So the real question here is, when clients know they're selling relatively soon, how do you both advise them on whether to keep paying down the mortgage or start building liquidity for the next purchase?
Yeah, it's a great question, and it comes up often. I'm sure you get asked it quite often, and I would sort of take a look at the state of the market, sort of how it is right now, and if prices are softening, I don't think it makes too much sense, especially if you've got that shorter time horizon, to make those extra payments, because you could effectively just be throwing that money away if your home value comes down a little bit. So I'd, defer back to you and sort of say, instead of allocating that money to the mortgage, what could you do to sort of protect that money, keep it liquid for them, when the time is right for them to effectively make that offer on the new home?
Yeah, exactly. What we would say from a financial perspective is, if you know the exact date or month that you want to do it, maybe we could come up with a bond or a GIC for you that expires or matures, 2 or 3 months ahead of time. If you're not sure of exactly when you want to buy it, you can put it into high interest savings. Now, the difference of what we have relative to a bank is the bank's high interest savings typically are significantly lower than what we offer. As of recording, we're paying about 2.6% on Canadian dollar deposits. So that typically would beat the bank's, call it 1%. So even while you're just keeping money idle ready for a house purchase, we can kind of keep it flexible for you. And then when you say to either Jesse or myself, hey, I'd love to purchase a house, we're trying to get pre-qualified, that your money is completely liquid.
And it's also, so on that point too, being liquid is super key, because when you do make an offer on a new home, let's say your realtor calls and an opportunity comes up that you have to sort of act on relatively quickly. With that offer, you have to provide a deposit, of course, and that deposit needs to be cash that you have on hand, liquid, ready to go to buy a certified check or a draft to attach with the offer. And, if you've paid that extra money that you've got between now and when you need it, it may be effectively locked in to the mortgage if you don't have a built-in line of credit or something like that. So yeah, I think on that short-term time horizon, having that liquidity is key. And then taking a look at, what the sort of market is doing, are important, things you need to consider on that sort of time frame.
Yep. Yeah. And one of the things I've always get asked in this is, I'm thinking about buying a house. Should I just put it into a bunch of tech stocks and see if I can double it? Don't do that.
No, yeah. I mean, you could, but don't expect it's going to be there tomorrow, I guess.
Exactly. Yeah. And exactly. And then when you come back to, somebody like yourself and you say, well, my 100,000 I had, with Harry that I put in the market is now 75. How much can I qualify for? It might reduce the opportunity for you to buy the house that you really want.
Absolutely. Yeah.
Yeah. What we would say is, generally 12 to 18 months still is a very low risk time frame. Once you get past that, you might say take a bit more, but generally speaking, if you're saying 6, 12, 18 months, talk to Jesse, talk to myself, we'll put it in something safe, make sure that you have it. And as long as it's growing a little bit, keeping a pace with inflation, at least you're not losing money, keeping it in a checking account.
Right. Exactly. Yeah.
Perfect. Well, one other question, this one's called the registered account maximizer. The scenario is a professional in their 40s has maxed out both their RSP and TFSA contributions. And after all that has about $2,000 to $3,000 monthly surplus after all expenses. Really, really good scenario. They've done really good tax planning, financial planning and everything. But what they're doing right now is they're torn between aggressive mortgage paydown or non-registered account investing. So the question here is, for clients who've maximized their tax advantage accounts, how do you weigh the guaranteed mortgage interest savings against potential investment returns in taxable accounts?
Yeah, I think that's a good one. And I mean, you'd be the specialist in terms of, best ways to invest, but somebody that's young has a really long time horizon. So that money being invested can go a very long way, to building that nest egg for later, even if it is a non-registered account. Somebody of that age too, maybe in their first home and may have, plans to buy a larger home later. And so building up those funds for potential down payment on the new home down the line, I think is, something worth considering. I'd look at the interest rate environment at the time. Obviously with a non-registered portfolio, there could be some tax exposure there. And so you just want to look at, net of taxes. Can you achieve a greater return than, the interest amount you'd be paying on the mortgage itself? In a scenario like this where we have clients that have additional income left over at the end of the day. I always think about a product that Manulife has that can really take advantage of that additional income that you have and reduce the interest overall. That's probably, an episode for a later day about that product because there's a lot to talk about, but it can really, help you pay down the mortgage aggressively over time, but still keep that money liquid if you ever need it. But yeah, I would imagine somebody with that additional cash flow, they could do great things with their savings portfolio with you.
For sure. Yeah. A lot of people say, Harry, I returned 10% last year. My mortgage is 3%. Why don't I just give it to you? Give me 10% and then I'll,
Absolutely.
have free money to pay down the house. And it doesn't quite work that way. I wish it did, but you want to take a look at what your interest rate is because that's, for fixed people, it's fixed. For variable, maybe the payment's the same, but either way, it's pretty known what you're going to be paying, at least for this month.
Right.
So the market itself, especially with what's happening, can be very unpredictable. It could be up 2% today, down 2% tomorrow. So we don't really say hey, your expected return is X because when we ever say something like a portfolio of your risk should return X, what we're really saying is over the very long term, the average past rate of return was close to 5 or 6 or 7%, not necessarily what you're going to be earning shortly. Yeah.
And I'd sort of look at some sort of recent events that we've been through where rates really sort of bottomed out, right? A few years ago, and people renewing now are renewing at rates that are double, if not triple, some, higher. And so mortgage payments are a lot higher than they once were. And so for anybody, who did get one of those ultra low rates at the time and was able to just pay whatever the required payment was and save that additional money, there could be a point in time where rates increase, your payment goes up. But if you did have that amount of savings set aside, one of the things you could potentially look at would be to take that money out, make a lump sum payment, bring the mortgage down, which would bring your payment down. So it gives you flexibility and options, really. So I think the key thing would be diligence, right? If you're going to take advantage of the low rate on the mortgage, make sure you do put that money aside in a portfolio and some sort of investment so that if you ever do need it, it's there and, ready to go.
Yeah, I think, the overarching response here to this question is make sure that you're having a conversation with one of us or both of us.
Yeah, absolutely. Yeah.
If you have a very low rate, it could make sense to invest. It also depends on your time frame, your risk tolerance, number of different things. But, generally speaking, I would say that, paying down your principal does make sense because it helps you with your cash flow. Maybe that helps you save a little bit more with somebody like myself. But if the numbers of your mortgage is 10% and I can only return 1 or vice versa, the math changes. So I think the overarching question or answer to the question is just have that conversation.
Absolutely. Yeah.
We'll move to another question called the career starters priorities. So in this scenario, a young professional just started contributing to workplace retirement savings, but has accumulated cash sitting in low interest accounts. So things like checking or savings at a bank. They're trying to balance building their financial foundation with home ownership costs. The question here is, when working with younger clients who are still building their financial base, how do you help them prioritize between emergency funds, retirement savings, and mortgage acceleration?
Yeah, I mean, this is something that absolutely requires some planning. Also, I like to have my first-time home buyer or younger clients work out a budget and take a look at where their money is going on a monthly basis to see, what they're bringing in, which is an easy one, payroll, your income, but where it's actually going in terms of where you're spending your money. And this can help, set a path forward in terms of how to best balance out savings for a potential home, maintaining savings for retirement and a rainy day or emergency funds, but also maintaining the lifestyle that you want to have. So the answer to that, I think, and you've got probably, you have a wide range of clients. The answer to that's going to be different for everybody. But I think at the end of the day, if you are younger and you're prioritizing, over the next few years, I do want to buy a home, there's maybe a heavier tilt towards saving money in a FHSA, or an RSP. If those are maxed, then maybe, a TFSA. I think when you're younger too, you also want to take advantage of any employer plans that you've got because many of them will provide some matching contributions. And that's an easy, quick way to boost your savings. And I would, that's the kind of thing that you go through with your clients in a planning session, right?
Yep. Yeah, we would say, what's your time frame? What's your risk tolerance? It's all part of a financial plan, and budgeting is definitely part of it. I think some people, when they hear budgeting, might shriek and say, am I going to the dentist or something? But really, the way to think of a budget is just like, how much can you allocate to something that you're trying to build tomorrow while still, keeping your day-to-day lifestyle the way you want it. And then projecting that. So if you say, hey, I need an emergency fund, what we would say is call it 3 to 6 months of savings, 3 to 6 months of expenses. If you're looking to retirement, as you mentioned, really max out those employer contributions. Yeah. And if you're looking to a mortgage, then you might do exactly what you just said. First home savings account generally comes first because of the benefit weigh-in.
Yeah.
RSP up to a current maximum of $60,000, and then from there to a TFSA. But, just as you mentioned, it's all about speaking out the plan. Who are you as a person? What's your risk tolerance and what's your time frame?
And it's funny, many of my clients that go through the budget worksheet that I send them, we will oftentimes find ways to save the money somewhere. It can be a real eye opener to see how much is spent on restaurants and going out, or how much is spent on streaming services and internet and all this kind of stuff. And usually we can chisel out some savings somewhere to allocate, that money towards maybe, saving a little bit more or paying off the mortgage if they already have one. So the budget, you're right. It's never a fun thing. Nobody ever wants to do it, but it is a great feeling once you have actually completed it and you have a visualization of, where your money is going, because it really puts you in control of your money. And that can be a really powerful feeling when you are getting to the age where you're starting to plan for retirement, buy a home and whatnot. So I'd encourage everybody to go through a budget. And also, even if you've been through a budget, a lot can change in 12, 24 months. So it's always a good idea to maintain that control of your money and take a look at your budget, every year or two, if not, right?
Yep. I think the operative word there, Jesse, is control. I think a number of people might say, especially these days, younger buyers, first-time home buyers, that the goalposts are moving further and further away, despite them working, a job that pays a good amount, but the house purchasability is still far in advance. Sometimes it might seem like, what am I doing? Why am I saving? If, I can almost never afford a house, I might as well just enjoy my life. I do think there's some level of respect to that. I think there's also, if you can take control of your investing and your finances and your budgeting, you can have both.
Yes. Absolutely.
You can prioritize a little bit more one or the other. I'm not saying take all your money and never travel again. It's take some money, put it away, take some money and save it for your day-to-day life. Now, moving to question number 4 for a business owner. I think this one's really interesting, actually. So the scenario is a small business owner has variable income and has some retained earnings within their corporation. They're considering whether to take money out personally to pay down their mortgage or keep it invested in the business and maybe invested in some stocks and bonds. So the question is, how do you approach a mortgage versus investment decision differently for a business owner who have both personal and corporate money to consider?
Yeah, so that's a great question. And we come across it often. There's so many self-employed business owners in Canada. So it's so common. And the nice thing is, speaking from sort of the mortgage side of this conversation, there are a lot of options if you are a business owner in the way that lenders look at your overall financials. And I'm not just talking about your personal tax returns. I'm also talking about your corporate financial statements, any money you have invested in the name of the corporation. So there's a lot of options and there's a lot of ways to look at it. I find most business owners want to draw down as little income as possible from their corporation. And of course, that minimizes tax exposure. So I would say, obviously that's a conversation to engage your accountant in as well to see, if you were to pull out some money from the corporation, what's the tax bill on that? And then effectively, how would that play out on the mortgage side? How much would it really save you? If it's not going to save you more than what you're going to pay in tax, well, then I don't know that it makes sense. And so you may want to keep that money isolated in the corporation. Now, if you're sole proprietor, it's a little bit different. Again, the lens is a little bit different in terms of how you qualify for a mortgage, but there are still tons of options. Cash flow for business owners is also super important. So that's something we want to sort of project out. It's one thing to say you're approved for a mortgage, here's your monthly payment. What does the individual sort of anticipate on the business side of things in the future? And how do we make sure that the payment that they're going to be sort of, say, locked into for 3, 4, 5 years, make sure that's still manageable in the years ahead, right? So that is something that, engage your accountant with. And I think for the most part, most business owners want to keep that money in the corporation. They incorporate it for a reason. And so that's where you come in and you'd be able to invest that money appropriately and
yeah, I think in this case, you hit on the head exactly, or the nail on the head exactly where you need to be here, because bringing your accountant in on this discussion makes the most sense. This typically would need, when you're dealing with an incorporated business owner, you definitely need an accountant, because a lot of the business owners I work with say, keep it in the corporation because I'm not really paying much tax on it. Mm-hmm. The downside there is that you're actually reducing the amount of RSP and CPP room that you have. You're not maximizing, even if you pay tax, on the way out, you get a benefit from putting it into your RSP. So typically we see that being even, if not, an advantage to taking it out. But it also kind of makes sense when you have the math in front of you. So for example, just answering the last question, how much is your mortgage? How much tax are you paying? What's your expected rate of return? These things typically might involve, somebody like yourself, somebody like myself, and an accountant. So it's pretty complex, but really it's just sort of, yeah, it's definitely collaborative. It's definitely, a lot of addition and subtraction, but, it also could be psychological. I've had a number of people say, I really don't want mortgage debt, at all.
Yeah, true. Yeah.
So if that's what you want, we'll show you the math, but could really just say like, what's the math on keeping it in your corporation? What's the math taking it out?
Yeah, for sure.
Now, moving to question 5. So this one's a first-time home buyer. So I've received a number of questions like this. Number of my clients, you've probably read in the markets that, the age of the first home buyer is actually becoming closer to 40. So it's kind of as, atypical than normal years, but
yeah.
We've seen this scenario before, so it's certainly something that's really applicable. A couple gets approved for significantly more mortgage than they expected. Perhaps, let's just say in this example, $100,000 to $200,000 more than they thought they could initially afford. They're wondering how much should they actually borrow. And I think when we were working together, I did see this a lot in 2020. You get approved for, X dollars and you say, well, I can buy X dollars worth of house. Whether or not that makes sense or not, we'll get into that. But the question here is, when clients get approved for more than they anticipated, how do you help them determine what they should realistically borrow rather than what they can qualify for?
Yeah, it's a great question. And you're absolutely right. Like when rates bottomed out, people were qualifying for, often clients would be surprised at what their pre-approved amount was. And, everybody's a little bit different in terms of, what their goals are for home buying. But I think the budget comes into play here as well to take a look at, yes, you could max out, and borrow more than maybe you thought you would, but how is that going to impact, your day-to-day life? There are a lot of expenses that we all have that are not factored into a mortgage application. Car insurance, daycare, lifestyle and hobbies. We all have a number of expenses that really aren't captured in what we call the debt ratio calculation when lenders are qualifying you for a mortgage. And so, yes, you may be able to max out, but what are you going to give up for that, maximum home purchase price or maximum amount? Now, the market that you're in, I think comes into play a little bit here. I think the reality of some of the larger cities across the country, to get into a home or to buy that home, maybe you are leaning towards sort of the max side. But again, it's a conversation to take a look at your life and your budget and your income and say, where am I at professionally? Do I expect a raise in the future? Well, yeah, maybe you're willing to take on a little bit more of a short-term, larger mortgage amount because you're going to have some more income in the future. So there's a lot of stuff that comes into play. And I just think it takes a little bit of, self-inflection to say, okay, am I, comfortable with, say, a $4,000 a month mortgage payment, or would I just prefer $3,000 and have that extra $1,000 a month for everything else that my life has, all the other expenses in my life, right?
Yeah, I've rarely seen somebody do that. So you have lots of discipline if you can. In a lot of cases, have you seen people say, okay, my payment's $6,000, I'm making $15,000 as a household, so this is totally fine. But then they don't factor in things like the land transfer tax, the realtor fees, the home inspections and things like that. Are you seeing, not hidden costs, but sort of unexpected costs impact their decision?
Yeah, for sure. I mean, land transfer tax is obviously a big one. So that's one of the, pre-planning things we do when we go through a pre-approval. Is it's one thing to say you're pre-approved for X, this is what the payment is. When you buy that home, here are the costs. So this is what you need to have over and above the mortgage to be able to take possession of that home. And, it can be an eye opener. Where we see a lot of surprises is sort of in that brand new home space, primarily in condos, where during the initial launch phase, where they sell units, and over the course of a few years while that project is being built, there may be additional costs that come up that are, of course, passed on to the purchasers. So fees and levies are something that come up quite often and can be a surprise on closing. But yeah, that's all part of the planning. So if you're sitting down and you've got a mortgage approval, the conversation shouldn't stop there. It should be walking you through, okay, here's where things go from here. You find a home, you make an offer. Do you have the money liquid for the deposit? Here's how much extra you're going to need to actually get the keys on closing day. And then, of course, you don't want to move into your new home and have $0 in your bank account. You want to, maybe do some upgrades to the home, maybe buy some furniture. Life still goes on regardless of how much money you borrow on your mortgage. And so you want to make sure you've got, I think, in the investment industry, everybody talks about, having 6 months of expenses set aside, right, as some savings.
Yep. Yeah, it's having that cash on hand makes a lot of sense. And sometimes I just see people holding on to it and saying, I'll never spend it. But really, this is an emergency. It would qualify for something where I'd say, consider dipping into it as long as you can repay it responsibly.
Right.
Now, a lot of people, when they do get pre-approved, they'll say, Harry, send me everything I got. And it puts them behind on their investing journey. They might have a ton of money into their house, but it impacts the liquid cash they could have in retirement. So, if somebody said, Harry, I got pre-approved for a little bit more, what do you think? Let's take a look at the financial plan first. But you'd be pretty happy in most cases saying I have excess cash every month instead of saying, oh man, Harry, I need you to send me $1,000 a month, because I overbought. So
totally
really, again, here, have the conversation, look at the plan and just do the math, making sure it makes sense for you.
Yeah, for sure.
So we'll move into the last question. It's about rate environments. So this one I get all the time. It's basically a client is renewing their mortgage and must choose between variable and fixed rates while also deciding how to coordinate this with their investment portfolio and their financial plan. So the question here is, how do you work together to help clients make mortgage rate decisions that align with their broader investment strategy and risk tolerance? Yeah,
I mean, this one is actually, I'd say for the majority of people, pretty cut and dry. A lot of people have preconceived notions of what they are comfortable with. And at the end of the day, it's like a similar to their investment portfolio, the way their investment portfolio is structured could tell a lot about what they're comfortable with in terms of their mortgage rate. Sometimes yes, sometimes no. But, people have very strong opinions about variable rate mortgages. They're either all in, yes, I love it, or absolutely no way, I don't want it. And then you have some people that are saying, you know what, maybe just a little bit. And, there's products where you can sort of have both a fixed and a variable. But if you ultimately have to decide one or the other, it's pretty simple to, within a 30-minute 1 hour conversation with the client, figure out whether or not they would be comfortable with the variable rate or not. Fixed rates are great. They give you peace of mind. It's consistency, and there's not a lot of that in life. And so a lot of people will just naturally gravitate to the fixed rate thinking this is great. There's no risk. What can go wrong? My rate's locked for a certain number of years. The risk with fixed rates, and this has happened numerous times over the years, is that rates come down and now you're paying above what current market rates are. Now there's ways to get out of that and refinance, and there's penalties involved, but it's simple math to determine whether that makes sense. But I can, and maybe it's just because I've been around for a while, tell pretty quickly who would be comfortable with a variable rate mortgage versus who is best suited for, a fixed rate term. I think the market dynamics at the time have a little bit of, part of that decision making, but it doesn't really matter what's going on in the world, really, because at the end of the day, we do not know where rates are going to be 6 months from now, 24 months from now. And so I just always tell my clients, listen, go with your gut instinct. What are you comfortable with here? Are you going to be, waking up every morning, looking at bond yields to sort of figure out where the variable rate's going? That's probably not the best decision for you. I'd probably think a fixed rate would, be better. So yeah, it's a conversation that we can sort of determine, the best answer for relatively quickly.
Another thing that we typically see is, okay, if I'm paying variable, what's my payment? And I know that you might be able to comment on this, but there's variable rate, variable pay, and variable rate fixed pay.
Yeah, so that's great. I'm glad you mentioned that because that's a big one that for a long time, people really didn't pay attention to that because, there was a period prior to the pandemic where, the Bank of Canada did not change their rate for almost 4 years. And so things were very stable. And so when it came to a variable rate mortgage, nobody wasn't really in the conversation. Does my payment change? My mortgage payment, does it change if there's a rate change? Because it just wasn't happening very often. Then we've gone through this roller coaster ride of rates shooting up, rates coming down. They're sort of plateaued right now. Forecasts out there do expect some rate cuts over the next, 12, 18 months. But I think that's always part of the conversation and something I talk to my clients about. Even if they're considering a fixed rate term, I like to let them know that there are variable rate mortgages that the payment will adjust based on whatever the rate does. So if the rate comes down 0.25%, your payment will reduce based on that lower interest cost. There are lenders out there that leave the payment as is. So your internal ratio of principal and interest will change. But for people that are perhaps maxing out, borrowing the most that they can today, they want a variable rate mortgage, but they kind of want to have a little bit of a comfort level that perhaps they could pay less as time goes on because the expectation is rates come down. Well, then we look at a lender with a rate that, with a payment that will come down as the rates come down. So yeah, that's an important one to take a look at. And I think for business owners, I find a lot of business owners prefer, if they choose a variable rate mortgage, they certainly prefer a lender that adjusts the rate because it means they have to take less income potentially from their business, which can often be a good thing.
And I find a lot of people who have variable mortgages, they could benefit from engaging with their financial planner to have some cash on hand if their payment goes up. So for example,
yeah, absolutely. It can go the other way. Yeah,
exactly. So if you had that, discussion with your financial planner and say, okay, I'm considering a variable rate mortgage. My payment is X dollars a month. What kind of buffers can I have if it goes up and how can I pay for it? As we mentioned in the last question, you don't want to take money out from your RSP. You kind of don't want to take it out from a TFSA. So the location of the money that you're taking it from is important. And of course, for business owners, is it corporately held? Is it personally held? Can you distribute it as a dividend? Is it eligible? There's a number of questions that relate to how I can get money to pay the mortgage. So again, having that conversation really, really helps.
And this is how we can sort of model things out. I'll give you a quick example of something we've looked at before is, if the rate comes down, your payment comes down, and let's say your payment now is $200 a month less than what it was before because the rates come down. putting that into an investment account, let's say, and you do that for a few years, you save that money, your mortgage is up for renewal. You now have this nest egg of funds that really you haven't felt much because your payment came down. Money outflow is about the same. You've got this chunk of money. You could keep it invested, right? Depending on what your plan is with yourself, right? Or you have this money that you could make a lump sum towards the mortgage on the maturity date. You can make large lump sum payments over and above regular prepayments. You can do that, without paying any penalties. So yeah, it's a nice way. And it's always something that we bring up when we're doing that planning with the client to sort of say, okay, you're going to save this on the mortgage. Often it comes into play with refinances. If somebody's going from a higher rate to a lower rate, well, what do you do with that extra money now? And that's exactly where you can sort of model that out and say, okay, well, over the next 3 years, if you're saving yourself $200 a month, here's what you could have in a few years. And I think that's pretty powerful for people to see, what they can do with that extra money.
Absolutely. So that kind of brings us to the end of the episode. There's been a number of different topics we've discussed here today, but if you did want to talk to either of us, our information will be in the description below. And I just want to say, Jesse, thanks for returning back to the show. We really appreciate your time today.
It's an honor, Harry. Thank you so much. It's great to see you.
Take care. Until next time.